Let's look into an illustration here. Now, A Limited has two factories, X and Y, producing the same article whose selling price is 150. Capacity of X is 10,000, capacity of Y factory is 15,000 in units. Variable cost per unit is rupees 100 and rupees 120 respectively. Fixed expenses are rupees 3 lakhs and rupees 2,10,000 for X and Y respectively. We have to determine the break-even point of two factories of the company, assuming as a whole. When we say as a whole, we are talking about the composite break-even point. And herein we are trying to find out as per the constant sales mix approach and the variable sales mix approach. So, when we are talking about the constant sales mix approach, how do we calculate the composite break-even point? So, we would take the contribution per unit. So, we can first calculate the break-even points of the two factories separately, wherein it will require contribution per unit for factory X and factory Y. Contribution is nothing but sales minus the variable cost. Selling price is given to us as 150 for the product. Variable cost for factory X is different and factory Y is different. Therefore, it gives a contribution per unit for factory X as 50 and factory Y as rupees 30. Fixed expenses again are different here. It is 3 lakhs and 2,10,000. So, the break-even point as such is calculated as fixed cost upon contribution per unit. So, we can calculate for two factories separately. The break-even point is for 6,000 units for X and 7,000 units for Y. 2 by 5 into rupees 50 plus 3 by 5 into rupees 30 gives us 38 upon 150, which is nothing but 76 by 3. And your combined fixed expenses are working out to be 5,10,000, that is 3 lakhs for X and 2,10,000 for Y. Once we have done that, what we get is 5,10,000 and this we will divide it by the combined PV ratio. That gives us in rupees the BEP as 20,13,158 as our BEP in rupees which we get. At a sales price, if it is uniform, the mix ratio in the capacity ratio itself is 2:3 because we are saying 10,000 and 15,000. So we say the ratio is 2:3. So this particular 20 lakhs 13,158 would be divided in the ratio of 2:3. That gives us for X it is 8,05,263 or divided by 150 rupees selling price you would get 5,369 units. Whereas for Y, the selling price works out to be 12,07,895 or 8,052 units. This is as per the constant sales mix approach, wherein we took the capacity as constant as to 10,000 for X and 15,000 for Y. So we got it as 2:3 as the ratio. PV ratio also we determined by 2:3 and we also divided our total BEP in the ratio of 2:3. If the same question has to be done and we have to find out the composite break-even point based on the variable sales mix, then how do we do it? As the factory X is giving higher contribution, it shall be used in full, that is 10,000 units should be produced here before production commenced for Y. This will give a contribution of 5 lakhs. So total fixed expenses of both the factories are 5,10,000. And that additional contribution required to meet the fixed expenses fully is 10,000 because contribution of X comes to 5 lakhs. So we require an additional contribution of 10,000. So number of units to be produced at Y to recover this fixed cost of 10,000 would be 334. And therefore, we have the total number of units for X would be 10,000 and Y would be 334. So, total number of units would be 10,334. We have understood in that above discussion, we can also apply to an undertaking selling different products, each having its own contribution and sales potential. The composite break-even for business should be worked out keeping the product mix constant. This would involve working out of the composite PV ratio as we did it in that constant sales mix.